Okay, so I'll be solving a question from the specimen exam, which some of you told that you needed some help with. This is a question on risk management. Everything else is pretty much the same here, except for one fact that there is a discussion on mark to market, which is not there in too many questions. I think there's just one question in the exam kit, where you have some discussion on mark to market. I think it's Dicon company. This is another one. So let's have a look at it. Okay. Explain the rationale for the policy of hedging Boolean companies' foreign exchange risk and the potential benefits to shareholder value if that policy is effectively communicated to the company's key stakeholders. So, rationale for the policy of hedging forex risk and benefits to shareholder value if that policy is effectively communicated to the stakeholders, and recommend a hedging strategy for Boolean companies' foreign currency receipt in 6 months' time based on the hedging choices the finance director is considering. Support your recommendation with relevant calculations and appropriate discussions, including the impact of the margin requirement. Okay, let's have a look at the question first to understand what exactly are they saying. The following exhibits available on the left-hand side of the screen provide information relevant to the question, the company and its hedging policy, and then the hedging products. Boolean Company is based in the Eurozone and manufactures components for agricultural machinery. The company is financed by a combination of debt and equity, having obtained a listing 5 years ago. In addition to the founder's equity stake, the shareholders consist of pension funds and other institutional investors. Until recently, sales have been generated exclusively within the Eurozone area, but the directors are keen to expand and have identified North America as a key export market. The company recently completed its first sale to a customer based in the United States, although payment will not be received for another 6 months. Nothing apart from background information here. At a recent board meeting, Boolean Company's finance director argued that the expansion into foreign markets creates the need for a formal hedging policy and that shareholder value would be enhanced if this policy was communicated to the company's other stakeholders. However, Boolean Company's CEO disagreed with the finance director on the following grounds. First, existing shareholders are already well diversified and would therefore not benefit from additional risk reduction hedging strategy. Second, there is no obvious benefit to shareholder value by communicating the hedging policy to other stakeholders such as debt providers, employees, customers, and suppliers. You have been asked to provide a rationale for the finance director's comments in advance of the next board meeting. What is the finance director saying? The finance director believes that you should have a formal hedging policy, and in order to improve the shareholder value, it is critical that you communicate this hedging policy to the other stakeholders of the company. You have been asked to comment on this part. Now, uh, the CEO of the company is of the opinion that there is no need to communicate it to the other stakeholders because it does not benefit them or it does not impact them in any way. Now, what is the idea behind, first of all, having a hedging policy? Now, if you were to think about how our two favorite management theorists, Modigliani and Miller, what they usually speak about, they mostly say that any policy is irrelevant. Like dividend policy is irrelevant, the way you finance your company is irrelevant. So if you were to think like them, the CEO is correct in stating that a company's hedging policy is irrelevant, because in a world without transaction or agency cost and where the markets are efficient, information is perfect, symmetrical, available to everyone, hedging creates no value if shareholders are well diversified. So shareholder value may even he doesn't, or Modigliani and Miller, these two, the CEO seems to be following their approach that whatever you do is irrelevant. So this approach of his, this thought process of his is basically, leaning towards the fact that whatever you do, whatever hedging policy you have, or even if you don't have a hedging policy, the shareholders are not really going to be affected by it. But you know that most of the assumptions given by Modigliani and Miller are, they don't really exist or hold any water in the real world. So what the CEO is saying, that it will not have any benefits or it will, not make a difference, that point is incorrect. However, in the real world where market imperfections exist, including the transaction cost of bankruptcy and other types of financial distress, hedging protects shareholder value by avoiding the distress cost associated with potentially devastating foreign exchange fluctuations. What does that mean? If you have a hedge, if you have taken some sort of a cover like a forward contract or a futures contract, basically it will help you to protect the company against any adverse movements. And active hedging, when you do active hedging, it will also benefit the debt holders by reducing the agency cost of debt. Basically, whenever the company uses a hedging policy, it acts as a signaling tool between shareholders and debt holders, because hedging allows for higher leverage and a lower cost of debt and reduces the need for restrictive covenants. What we are trying to say is that if you don't have a hedging policy in place, if you are not hedging your foreign exchange risk, if you are not hedging your interest rate risk, then naturally it will have an impact on the overall profit and therefore the fortune of the company. So having a hedging policy in place indicates that the shareholders, via the directors of the company, are taking care of the interest of the debt holders and everyone else that is to follow. Now, when foreign exchange risks are hedged, the question also arises, why do you need to communicate this with the stakeholders? So even when foreign exchange risks are hedged, the funding of various margin payments on exchange traded futures can create financial distress. What does that mean? Now, when you go for a foreign exchange option, or go for a foreign exchange future, or you go for options on interest rate futures, or any of these complex derivative instruments, you have to pay a certain margin to the stock exchange, and you have to keep on meeting the margin requirements. And those margins, also the premium that you pay on it, these are usually pretty high. And when you are trying to, in a way, protect yourself from foreign exchange fluctuations or interest rate fluctuations, you are at the same time paying a higher premium, and you are also marking it to the market, which is thereby creating a higher stress on your overall financials anyway. Now, the agency cost and risk of financial distress also impact the expected wealth of employees who, unlike shareholders, may not enjoy the risk reduction benefits of a diversified portfolio. What we are trying to say is that you need to communicate the fact that you are undertaking, or you are making use of various hedging instruments to your stakeholders for one specific reason. All of these stakeholders are going to be affected by the profits of the company, and they are going to be affected by the overall cash flow position of the company. When you go for these options while you are trying to protect yourself against some kind of foreign exchange or interest rate fluctuation risk, at the same time you are exposing the company to cash flow related challenges and profit related challenges. Why? Because you are primarily pumping in a certain amount of cash upfront in order to meet the margin requirements and to pay the option premium. So all of the stakeholders are going to be affected by the hedging policy of the company, and hence the management should communicate to the stakeholders all the entire hedging policy that the company has undertaken, and also communicate the additional costs that are associated with the hedging policy being undertaken, and the potential benefits that you will derive because of the foreign exchange related hedge or the interest rate related hedge. It is important that when you communicate this information to the stakeholders, communicate that if we employ this particular instrument, this is the foreign exchange exposure or the interest rate risk exposure that we are trying to cover. So this is the benefit that we are getting, and this is the additional cost that we are paying uh, for the hedging instrument that we are undertaking. Okay, and now to the numerical part of the question. Assume today's date is 1st of March. Bulan Company is due to receive 1 crore 86 lakh from the American customer on 31st of August 20x0. The finance director is keen to minimize the company's exposure to foreign exchange risk and has identified forward contracts, exchange traded futures, and options as a way of achieving this objective. The following quotations have been obtained. Exchange rates quoted as euro per US dollar. Spot rate is 0.8707, 0.8711. 6-month forward rate is given to you. Currency futures, contract size is 2 lakh euro. Exercise price quoted as US dollar per euro. March future, June future, September future. ठीक है. Currency options, contract size 2 lakh euro. Exercise price quoted as US dollar per 1 euro. Premium is US cents per 1 euro. They have given you the exercise price of 1.1420, and they have given you the premium for call and put. Assume futures and option contracts mature at the month end and that there is no basis risk. The number of contracts to be used should be rounded down to the nearest whole number in calculations. If the full amount cannot be hedged using an exact number of futures or option contracts, the balance is hedged using the forward market. Once the position is open, the Euro futures contract outlined above will be marked to market on a daily basis. The terms of the contract require Bull and Company to deposit an initial margin per contract with the clearinghouse. Assume the maintenance margin is equivalent to the initial margin. Your manager is concerned about the impact of an open future position on Bull and Company's cash flow and has asked you to explain the impact of the margin requirements and their significance for the hedging decision. Most parts are similar. It's only the impact of this on the hedging, impact of margin requirements. That is something that we don't see very often. Okay, but let's go step by step in this. We'll take each instrument in turn. We'll try to find out what is the impact of using that instrument, and we'll see what impact it has on the cash flow position of the company. Pretty much like how we do it usually. Now, what all do you have? You have a forward contract, you have futures, you have options. Okay, there are three specific instruments that we are looking at. Now, let's first of all try to see what happens with the forward contract. Nothing new here. Forward contract. This is my solution one. 6-month forward, euro per dollar. Okay, so 6-month forward rate. $1 equal to how many? 0.8729, 0.8729, 0.8744, 8744 euro. Okay, $1 equal to 0.8729, 0.8744 euro. What does that mean? That means bank buys $1 for 0.872, by mistake, 0.8729 euro, and bank sells $1 for 0.8744 euro. Okay, now what is the position? I will be receiving dollars. Okay, so Bull and Company will receive dollar. It will, this is a company in the Eurozone. It will take the dollar to the bank, sell the dollar. ठीक है? To do what? Sell the dollar to get euro in exchange. Okay, it will sell the dollar to get euro in exchange, and Bula company is selling dollars. So that means bank is buying dollars. And you know that bank buys $1 for $1 equal to 0.8729 euro. Dollar, euro. $1 equal to 0.8729. How many dollars am I receiving? I will be receiving 1 crore 86 lakh dollars. Okay, so 1 crore 86 to 1, 2, 3. So how many euros is that? 16,235,940 euro. So this is the outcome of the forward contract hedge. Okay, this is the first part. The second part will be for futures contract. We know how foreign currency futures work, and we know that instead of trying to be over smart in the examination and relying on our instincts, we prefer following the steps that we have so meticulously noted down for ourselves, right? So that is exactly what we are going to do. We are going to go through the foreign exchange related steps, and we are going to just foreign exchange future related steps. We'll put those in one place, and yes, that's it. So let me bring in the steps here. These are for futures hedging. Standard steps that I have given you in the class, steps that I expect you to follow very, very religiously. Step 1, identify the currency of contract. The lot sizes are given in euro, so currency of contract is euro. Okay. Now the next question, do you need to buy CC or do you need to sell CC? Okay. Do you need to buy euro or do you need to sell euro in the future? Okay. You are going to the bank, you are selling the dollar and buying the euro. Okay, you are selling the dollar and you are buying the euro in exchange. So you are going to buy the currency of contract, which is euro. Next step is exactly how many contracts do you require? Now I have told you that this step is a cosmetic one in our example. Why? Because we only use it to get that 1 mark from ACCA, but the calculations that we do later don't really depend on this. Okay. So number of contracts. How many contracts do you have? One contract is for 2 lakh and there are contracts, and so the total amount to be hedged is 18 crore 60 lakh, sorry, 18 crore, 1 crore 86 lakh dollar. Now here again you go back to the same situation. What you have is you have a certain number of dollars that you need to hedge, but your currency of contract is the euro. So now the question arises, how many contracts do you need? For this, you will need to refer to the market. You will have to refer to certain rates to first of all convert the foreign exchange to convert dollars into euros, and then you will have to perform your calculation. I want you to observe one thing here. You see what is the spot rate? If you observe, the spot rate is given as euro per dollar. Okay. And currency futures are quoted as dollar per euro. So you have to be very careful. Spot rate is $1 equal to euro 0.8707 dash 0.8711. $1 equal to euro 0.8707, or this is the bid rate and you have the ask rate. So what is going to happen in the future? In the future, I will receive dollar. I will go to the bank and I will sell dollar. I will sell dollar. That means bank will buy the dollar, and bank buys $1 for euro 0.8707. Okay. Now bank buys $1 for 0.8707. Now if $1 equal to 0.8707 euro, 1 euro will be equal to 1 upon 0.8707, which is 1 upon 0.8707, which is 1.1485. Now you have converted an indirect quote into a direct quote now. 1 euro, this is the spot rate, okay? 1 euro is $1.1485. Okay, now in the future, okay, now when is the customer supposed to pay? The customer is going to pay us on 31st of August. Okay, if the customer is going to pay us on 31st of August, these are currency future rates quoted right now. So on 1st of March, What is the spot rate? On 1st of March, the spot rate is 1.1485, and on 1st of March, the futures rate is 1.1422. Okay, we have the spot rate and we have the future rate. Now, what is the basis here? The basis here is difference between the two, which is 0.0063. This is on 1st of March. You are looking at a September future. So March, April, May, June, July, August, September, 7 months. Okay, so my unexpired months are 7. Now, when is the when is the customer paying me? I am receiving the money on 31st of August. So here, let me write 31st of August. If I have 31st of August here, how many months left to expiry? 1 month left to expiry. That means what is my basis? My basis is this upon 1 divided by 7, 0.0009. Now, what else do I know at this point in time? I need to have my spot rate. Okay. Now, if I need my spot rate or if I need my future rate, whatever it is that I need, can I calculate that with the current set of data points that I have? Please pay attention. Now, I need this futures rate, but I have no means to find it right now. Why? Because to do that, see, I have the basis, but I would need the spot rate on 31st of August. And if you observe the question, that rate is not given to you anywhere. In this case, I will have to use the lock-in rate formula. Okay. So, how do I get my lock-in rate? Opening future price, which is 1.1422 plus unexpired basis on the transaction date, which is 0.0009, and that makes it 1.1431. Now, you might have a question, why did I do this calculation? What is the point of, this entire working? Now, you see, what is happening here is a very peculiar situation. I need to know how many contracts. Okay, to know how many contracts, I should know what is the amount that I am hedging. I know that I am hedging 1 crore 86 lakh dollars, but this is in dollars and my currency of contract is euro. Now tell me, when am I going to give the euro and buy dollars? Or when am I going to, so not buy dollar actually, my customer will give me 1 crore 86 lakh dollars on 31st of August. On 31st of August, I will take the dollar to the bank, give the dollar to the bank and buy euros in exchange. That is what I am going to do. And on which date am I going to do this? I am going to do this on the 31st of August. So if I'm going to do this on 31st of August and today I want to know how many contracts will I end up buying or selling, I will need the futures rate on 31st of August to determine the number of contracts, right? So to determine the number of contracts, I will first of all, I will have to convert dollar to euro using the futures rate on 31st of August, which is 1 euro equal to 1.1431 dollar, and we are receiving 1 crore 86 lakh dollars. So the euro equivalent is 1 crore 86 lakh upon 1.1431. How many euros does that give you? 1 crore 86, 12123 upon 1.1431. So 1627,1542 is the number of euros that you is the euro equivalent of this amount is 16271542, and number of contracts will be 16271542 upon 2 lakh. So this upon 2 lakh. How many? 81.3 36 contracts. Because this is 81.36 contracts, we are going to round it down and say 81 contracts. So, okay. So round it down and make it 81 contracts. Okay. What is the expiry date? The expiry date is September. Okay. Just one point of attention. So, what is the amount of euro hedged? 81 contracts into 2 lakh euro per contract. How much is that? 2 lakh into 81. 16 or 1 crore, 62 lakh is the number of euros that you have hedged. So that means there is an amount that has not been hedged so far. Okay. So that under hedged, what is the amount of euros under hedged so far? It is 71,542 euros that have still been under hedged. Okay, so we'll keep this amount outside for a moment. Okay, let's keep this amount outside for a moment. Now, let's go to the next step, expiry date, which is September. Contact the exchange, sell the futures, pay the margin charges, whatever it is. Close the future contract by taking an opposite position and calculate the gain loss. Original this thing, then calculate the outcome if settled at the spot rate, calculate the net receipt or payment. But the thing is, in this case where we have the lock-in rate, we don't need to go through all these steps. We straight away get the final answer. Okay, so you don't necessarily have to go through all these stages. You have the lock-in rate, which is going to give you the final answer in this. Because we are using the locked-in rate, which we already calculated in the previous tab, when you have the lock-in rate, you get rid of all of these steps. Okay, so when we have the lock-in rate, it gets rid of the of steps 6 to 8 and gives us the final answer. Okay, our locked in rate was 1 euro equal to 1.14. 1 euro equal to 1.1431. $1.1431, and we hedged by taking 81 contracts, which means the outcome is this much: 162,12123 euro. And you have an unhedged amount of 71,542. Now, all you have to do is you have to understand what is the impact of this. How are you going to hedge this particular part? Okay, so let's get to that one. But the thing is, ultimately, the currency whose movement you are actually hedging against is the dollar. So the amount under hedged is 1 crore 86 lakh dollar minus 81 contracts into 2 lakh euro per contract into $1.1431 per euro. How much is that? So 186,12123 minus 81 into 2 lakh into 1.1431 This is how many dollars? These are 81,780 are underhedged. Okay. 81,780 are underhedged. How much would that be in terms of euros? You will have to convert it using the appropriate rate, which is 0.8729 6-month forward rate for the underhedged amount. Use the forward rate. So this will be hedged using. You were supposed to hedge 1 crore 86 lakh something dollars, but you hedged a lower amount. So the differential amount, which is not hedged using the forward contract, which is not hedged using the futures contract, has to be hedged using the for has to be hedged using the forward contract. So you will use the rate $1 equal to 0.8729 euro. Okay, so 81,780 dollar will be equal to 81,780 upon 0.8729, or rather no, not divided by. See, even after doing things for so many times, I still end up making mistakes if I'm not careful. So what makes you immune from that? Nothing does. Actually, you could have gotten a similar answer here, but then it's not the most scientific way to get things. That is 71,542. This is 71,386. So what is the total outcome of the hedge? The total outcome of the futures hedges, outcome of futures plus hedging unhedged amount using forwards. Outcome of futures 1 crore 62 lakh plus 71,386. So the futures hedge is giving you 162, 71, 386. Now see, whenever it is under hedge, that means you were supposed to hedge a higher amount, but you hedged only one proportion or one part of it using the futures contract. So whatever amount is remaining out of the total exposure of 1 crore 86 lakh, $81,780 are under hedged. So for these, you will use the forward contracts. Okay. So you use the forward contracts and you got your answer 71,386 euros, and you have the final impact of the futures hedge with you. This is an under hedging situation. See, over hedging, you have to apply a little more mind. But here under hedging, you were supposed to hedge 1 crore 86 lakh dollars. You hedged a slightly lesser amount. So for the differential now, what you are doing is you are taking a forward contract. It's quite a simple way of doing things. Now, when it comes to options, okay, let's understand how the option calculation is done. Just hang on a minute. And now the last hedging instrument, which is the options contract. Now here, if you observe, again, the contract size is given in euros. The exercise price is quoted as US dollar per euro. Premium is US cents per euro. The exercise price is 1.1420. Okay. Now, how many contracts will you have? First of all, we'll have to calculate the number of contracts. For that, see, the exposure is in dollar, but the currency of contract is euro. Correct. So let's go through this step by step. What is the currency of contract? The currency of contract is euro. Call option or put option. Are you going to buy the currency of contract or are you going to sell the currency of contract? What is the situation here? Now, what you are getting is you are getting a receipt in dollars. You receive dollars. Those dollars are of no use to you. You go to the bank, you give the dollar, that is, you sell the dollar, and you buy euros in exchange. When you buy something, it is a call option. So, call option. What is the expiry date? We have a September expiry. Which exercise price to be chosen? Luckily, here we don't have to worry about it. There is only one exercise price, and exercise price is quoted as dollar per euro. So exercise price is 1 euro equal to $1.1420. How many contracts? This is now going to be a tricky step. What is your exposure? Exposure to be hedged. Exposure to be hedged is 1 crore 86 lakh dollar. But my currency of contract is euro. Okay, so I cannot divide this by 2 lakh. I'll have to first of all convert it to euro using 1 euro equal to $1.1420. Okay, so how much is that? 186, 12123 upon 1.1420. So this is my overall exposure. Okay, in euro terms. Why am I going through this entire charade? The only reason is my currency of contract is euro and my exposure is in dollars. So now I will get the number of contracts, which is this upon 2 lakh, 81.44. Again, what I'm going to do is I'm going to round it down to 81 contract. Excuse me. Round it down to 81 contracts. So that means there is going to be an underhedged amount here as well. Be careful about that one. Let's calculate it here only. Amount. See, again, I'll go back to this line. The currency use movement you are actually hedging against is the dollar. आप dollar को hedge कर रहे हो. ठीक है. So, what is my amount under hedged? 1 crore 86 lakh minus 81 contracts into 2 lakh euro per contract into what? Into $1.1420 per euro. So it gives me an underhedged amount. Amount underhedged is $99,600. When the amount underhedged is $99,600, what I'm going to do is this underhedged amount will be tackled using the forward contract. Okay. Now, what is the forward rate? I'm going to use 0.8729 euro per dollar. So 99,600 dollar into 0.8729 euro per dollar. कितना होगा? 99,600 into 0.8729. That is an amount of 86,941 euro. Okay. 86,941 euros. Multiple juggler read, and see, whenever you have an under hedge na, it's actually easier for you. And I'm going to give you one tip for the exam, which is going to be very, very handy if you find yourself in trouble. But more on that later, not right now. Hoping you are with me so far. Let's understand what is the outcome of this situation. Okay, now we have calculated how many contracts, blah, blah, blah. Now contact the exchange, pay the upfront premium and wait till the transaction date. You have a call option on a September future, right? and this is 0.77 cents per dollar. Okay, so what is my premium? My premium is 0.77 cents per euro. That is 0.0077 dollar per euro. This is my option premium. Okay. Now, how do I calculate the total premium to be paid? Premium payable. How many contracts? Basically, 81 contracts into 2 lakh euro per contract into 0.0077 dollar per euro. This is what you have to calculate. How much will this be? Let's see. 81 into 2 lakh into 0.0077. 124,740. 124,740 dollar. Okay. Now I'll need to convert these dollars into euros again because that's my currency. And I'm going to pay it upfront. So I'll have to use the spot rate, correct? Because all the premium has to be paid upfront. So I'm going to translate it using this rate 0.8711 and premium payable in euro terms 124,740 into 0.8711. 8711 euro per dollar. This is the euro part of it. Okay, this is the amount of premium that I have to pay. Calculate the amount using spot rate on the settlement date. Check which alternative is better. But here you have been told that the option is going to be exercised, so you don't have to worry about it. Now, what is the mark to market situation? Please read. Assume futures and options contract mature at the month end and there is no basis risk. The number of contracts to be used should be rounded down to the nearest whole number in calculations. If the full amount cannot be hedged using an exact number of futures or options, the balance is hedged using the forward market. Once the position is open, the euro futures contract outlined above will be marked to market on a daily basis. The terms of the contract require Boulan Company to deposit an initial margin per contract with the clearing house. Assume the maintenance margin is equivalent to the initial margin. Now, the forward and future contracts uh, fix the exchange rate with the futures contract, generating a slightly higher euro receipt. But the futures contract is also marked to market. What does that mean? This means that Boulan Company deposits an initial margin with the clearing house when the futures position is opened. The notional profit or loss at each day's closing settlement price is added to or subtracted from the margin account balance. If the margin account balance falls below the level of maintenance margin, Boulan Company is required to deposit additional funds to top up the margin, known as the variation margin. Okay, so in this case, whatever is the plus or minus that will either be deposited or you will receive it back from the exchange. Now, how much have you hedged here? Here you have hedged an amount of 81 contracts into. So, outcome of the contract hedged using options 81 into 2 lakh. See, when you arrived at this 81, what did you do? When you arrived at this 81, you basically took into consideration the rate of 1 euro equal to 1.1420. So you have considered this calculation on the basis of the exercise price. So this is the outcome of the options hedge. Okay, then premium payment upfront. How much? 108,661. And what is the forward market hedge outcome, because there was a part that had to be hedged using the forward market, which is 86,941 euro. What is the net outcome? The net outcome of the options hedge is 161,78280. Now, this is the worst case scenario if you really think about it, because you will pay a heavy option premium. The point is that see, the final hedging choice will depend upon board's attitude to risk. That remains. Assuming there is no default of risk associated with the forward market, it might be the best choice because it gives me the highest possible receipt. Now, what the company does, or what the company is required to do, is it is required to deposit an initial margin with the stock exchange, and then whatever is the notional profit or loss, that is added to or subtracted from. Had they given you the rate, what is fluctuating on a daily basis, you would have calculated that. Otherwise, this much is fine. Just explain in words, explain in paragraphs, how does the mark to market part work, and that is pretty much the end of it. We have discussed it just now, by the way, as to how the mark to market part works. Perfect. Thank you. Watch this video quickly, and it's an easy question.